Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I'm going to put the methodology aside for a minute and get back to the wisdom of Jesse Livermore. So this is part 3 on that. Housekeeping, I do take requests. It makes my job a lot easier. Tell me what you want what you want me to cover, and I'll be happy to cover it. If you need to reach me, DaveLandry.com/contact. If you want the slides from this presentation, all the other slides combined from all the other presentations, which include some systems and setups, etc., go to davelandry.com/StockCharts. I do a weekly webinar every week, and this one is still live. It's at 6 o'clock Central, 7 o'clock Eastern, and that's at davelandry.com/webinar to register. Twitter at TFollowingMoron and YouTube at Dave Landry. You can reach me also in those places. So for Mind to Trade, as I said, I want to continue my discussion on the wisdom of Jesse Livermore. I'm pulling mostly from Reminiscence of a Stock Operator, and this presentation comes from chapters 4 and 5, and we're not going to get through all of chapter 5. Chapter 4 didn't have a whole lot in it, but chapter 5 is really chock full of a lot of information. And I'm also going to eventually use the biography, which I'd recommend you read too. Go to davelandry.com/books-2-read for more on that. I'm going to use the biography to give a little color commentary to what's happened, to kind of fill in a little bit about the times and about Livermore himself. He said he went broke several times, and that is never pleasant, but the way I lost money is the way everybody loses money who loses money in Wall Street. Speculation is a hard, trying business, and a speculator must be on the job at all time, or he'll have no job to be on. So you have to recognize why you're losing money. You have to study what you're doing. And then the thing that's of most importance is it does take a lot of focus. And I'm going to come back to that a few times based on the wisdom of Livermore. Now, when he got to New York, as I've said last week and week before, he found out that the game had changed. And I'm going to show you one way he blew up in New York. And that's because in the bucket shops, he was able to execute quickly, and then he ended up with a lot of skiddage and slippage and frictional costs in New York. And again, I'll walk you through that in 1 second. I heard a lot of calamity. Howling and the old stagers said everybody, except themselves, had gone crazy. But everybody except themselves was making money. I knew, of course, there must be a limit to the advances and an end to the crazy buying of AOT, any old thing, and I got bearish. But every time I sold, I lost money, and if I hadn't been that I ran darn quick, I'd have lost a heap more. I looked for a break, but I was playing it safe, making money when I bought and chipping it out when I sold short, so that I wasn't profiting by the boom as much as you would consider how heavy I used to trade even as a boy. Some of the language is a little hard to read. But basically he's saying there was a bull market and everything was going up and you could make money by buying any old thing and hanging on to it, as we'll get to in a minute or two. You want to trade with the major trend. But he was too busy trying to scalp because that's what he did. Now, I am guilty of making way too many day trades, and you'll probably hear an alarm or two go off while I'm doing this presentation. I will tell you this, old habits do die hard. I've worked with a lot of day traders to make the transition over to position trading, and as soon as the trade goes a little bit against them, maybe the first day in a position trade, they tend to be out. And the big money is in the big pull, as Livermore calls it. We'll get back to that in just 1 second. Now, he got wiped out of New York because he got caught up in a fast market. If the unusual never happened, there would be no difference in people, and there wouldn't be any fun in life. The game would be merely a matter of addition and subtraction. It would make us a race of bookkeepers with plodding minds. It's the guessing that develops a man's brain power. Just consider what you have to do to guess right. So, he seemed to be philosophical. Now, the biography does say that he did get depressed from the markets itself, but in this fictional account that he did in Reminiscence, he doesn't seem to get depressed about the markets. So he's got the right philosophy. Whether or not he lived it, that remains to be seen, or that's up for debate, I should say. He did break his rules, obviously, a lot, because he blew up quite a bit, even after he sort of figured out the game. Now, in New York, the way he blew up one time was he saw a stock and he thought it was due for a correction, and he figured that longer term it still would head higher, but he thought he would play the correction and then get long eventually after shorting it. Now, at a bucket shop, no problem. So he sees the stock up at about $100, and he's thinking, you know what, this thing is due to sell off, so let me short it. And then in the bucket shops, you got instant fills, whatever the last ticker was. If it was a fairly active stock, whatever the ticker came in at, you would get that price. So if he sold at 100, he'd get 100. And then when the stock drops, if he bought at 80 to cover, because that would be the last ticker coming in at a price of 80, they would give him that last ticker price. Now, he found out in New York, and this is upon his second return to New York, this happened. And then after a while, it's hard to keep track of all his blow-ups. But he sold at 100, and the market was in a fast market. By the time it got back to him, it was already at 80. So he ended up selling at a level where he would have actually covered if he would have got his trade off. So when he goes to buy back the stock, he gets filled up at 100. So he got 20 points skiddage both ways, and he ended up blowing up his account from this. Now, after my ninth mishap, I plugged along using a modified but still defective method. If I hadn't made money some of the time, I might have acquired my wisdom quicker. Well, this is a big problem with trading, is the intermittent reward. And on my position stuff, I haven't been rewarded in a while, but you have to keep plugging away at it, provided you have a viable methodology. If you don't have a viable methodology and just kind of shooting from the hip, the market could be a really bad teacher. And as the people who design slot machines and casino games know, the intermittent reward keeps you coming back for more. In the case of the markets, if you don't have a conceptually correct, viable methodology, then the intermittent reward will just kind of help you to bleed to a long-term slow death. Now, as I often preach, you really don't want to use limit orders in the markets unless you're taking partial profits, or obviously in something like options where you really can't go in at the market, you will have to use limit orders. But if you want in a market, you want in. Whenever I did try to limit the prices in order to minimize the disadvantages of trading at the market when the ticker lagged, I simply found that the market got away from me. This happened so often that I stopped trying. I can't tell you how it came to take me so many years to learn that instead of placing piking bets on what the next few quotations were going to be, my game was to anticipate what was going to happen in a big way. So that seems like a big theme throughout, and I'm going to talk about that a little bit in just a minute, about going for a bigger picture move as opposed to trying to scout, which was really hard, obviously, when he got to real markets. The map was not the territory, is the lesson there. Now, in one of his blowups, he said, my winnings were not enough to offset both my losses and my living expenses. One thing he did was he lived a somewhat extravagant lifestyle for the amount of money he had. And then as time goes on, he got really crazy, and he blew up a few times, even once he was making a lot of money and had a very extravagant lifestyle, sell a 200-foot yacht and try to pay off all the creditors, etc., and then come back yet again. Now, in one of his blow-ups, he said his winnings were not quite enough to offset both losses and my living expenses. Well, he lived kind of large, so he didn't have a whole lot of money during his early blow-ups, but he lived a very good life considering the amount of money he actually was bringing in. So he did put a lot of pressure on himself to make money, and that's one thing I'd encourage you to do, is not have, or have as few as possible. There's always going to be a few, obviously, but have as few as possible financial constraints and obligations on you so you're free to trade and you're not so worried about the money. I didn't keep on trading the way I did through stubbornness. I simply wasn't able to state my own problem to myself, and of course, it was utterly hopeless to try to solve it. I think it was Kettering once said, a problem well stated is a problem half solved. So he didn't really fully wrap his head around why he couldn't make the money in New York that he was making in the bucket shops. He had to change his game. But he was continuing, as I've said a few times, to play his own game. I harp on this topic so much to show what I had to go through before I got to where I could really make money. My old shotgun and BB shot could not do the work of a high-powered repeating rifle against big game. After several years, I was back to where I began. No worse, for I had acquired habits and a style of living that required money, though that part didn't bother me as much as being wrong so consistently. So he's come to what psychologists call a forced awareness, which could be very painful. I was 20 when I made my first 10,000 and lost that, but I knew how and why because I traded out of season all the time. You want to trade when the odds are stacked in your favor. Because when I couldn't play according to my system, which was based on study and experience, I went in and gambled. I hoped to win instead of knowing when I ought to win on form. So basically he's saying instead of waiting for a setup and letting the markets come to him, for me, it would be an uptrend, a downtrend, and recognizing when we're in a sideways trend like we've been in for a long time. An uptrend is good, a downtrend is good. Now, an uptrend is much easier to make money in than a downtrend, but a downtrend is fine if you're a trader. And a sideways trend is bad. I'm assuming that you're a trend follower, and the real money is in the longer term trend following, and I'm going to get to that in just one second. I needed actual practice. There's nothing like losing all you have in the world for teaching you what not to do. And when you know what not to do in order to not lose money, you begin to learn what to do in order to win. To get that, you begin to learn. It seems like we all have to go through the school of hard knocks when it comes to trading. You want to make sure that you know as much as possible about money management. Of course, as I often preach, garbage in, garbage out. You want to pick the best setups to begin with. You're more likely to lose money on a mediocre setup than you will be on a fantastic setup. And even a fantastic setup, you can lose money on that. So you have to make sure you're placing your, and I hate to use the word bet, but you're placing your bet sizes accordingly where you're not risking too much. And I think 2% is plenty if stopped out on a sizable account. Now, if you have a small account, you're newer to trading, you might just want to risk a very small amount until you get your feet wet, until you get used to the ups and downs. And one thing that somewhere in these slides I'm going to say is that you're only going to be smarter in the future, so you need to remember that as you're trading. Now, this one took me a little while to wrap my head around it, but it makes sense once I read it a couple times. The average ticker hound, or as they used to call him, the tapeworm, goes wrong, I suspect, as much from overspecialization as from anything else. It means a highly expensive inelasticity. One thing that's vitally important is waiting for setups. And like I said, I believe last week, by watching the people in my Facebook group, some of the guys who really good traders and really good technicians, I find that their setups are getting a little bit more mediocre because we've been chopping around for so long, because they're not waiting for the perfection like they used to. And somebody told me recently, as I've been saying, they quit my service because they thought I was waiting for too much perfection in the market. No, that's just a function of the market. If we were in a raging bull market, then I would still be looking for the same amount of perfection, but you'd have 3 or 4 setups going into the next day as opposed to no setups on many days. Anyway, if a stock doesn't act right, don't touch it, because being unable to tell precisely what's wrong, you cannot tell which way it is going. No diagnosis, no prognosis, no prognosis, no profit. So make sure you're waiting for the best setups. Ignore the news. And if we're in a bull market, we're in a bull market. If we're in a bear market, we're in a bear market. If we're sideways, we're sideways. But not even a world war could keep the stock market from being a bull market when conditions are bullish, or bear market when the conditions are bearish. And all a man needs to know to make money is to appraise conditions. Well, right now, it's been pretty sideways. We've been improving here and there, but for the most part, we've been pretty sideways and choppy. So not a great market for a trend follower. Now, as I often say, you're going to be smarter in the future. I know now what I did not know then, and I think of the mistakes of my ignorance because those are the very mistakes that the average stock speculator makes year in and year out. That's one advantage I have is I see a lot of mistakes being made. Don't get me wrong. I make plenty on my own, but I'm able to see a lot of other people make a lot of mistakes, and it serves as a constant reminder of don't do that. So definitely learn from your mistakes, and you're only going to be smarter in the future. So trade at a smaller size today than you really think is necessary until you get really, really good at what you're doing, and then slowly up your share size. Now, that maximum, again, should be about 2% of your account value. The game of beating the market exclusively interested me from 10 to 3 every day. And after 3, the game of living my life. Don't misunderstand me. I never allowed pleasure to interfere with business. When I lost, it was because I was wrong and not because I was suffering from dissipation or excesses. There never were any shattered nerves or rum-shaken limbs to spoil my game. I couldn't afford anything that kept me from feeling physically and mentally fit. Even now, I am usually in bed by 10. As a young man, I never kept late hours because I could not do business properly on insufficient sleep. And that's one thing, again, getting back to the holistic trader, you have to make sure that you're taking care of yourself, obviously, because you really have to operate at peak performance in this business. I was doing better than breaking even, and this is why I don't think there was any need to deprive myself of the good things in life. The market was always there to supply them. I was acquiring the confidence that comes to a man from a professionally dispassionate attitude toward his own method of providing bread and butter for himself. Larry Williams once talked about being clinically dispassionate, and it was an excellent quote. And it's interesting, it's as I read these old books, I begin to see things that were in them long before anyone else said them. I often say things and then we'll later read in the book or somebody will say, that's not you that came up with that, that's someone else. So there's nothing new under the sun. In fact, that's one of the things that Livermore talks about a little further in the book. So again, he's talking about taking care of yourself. Now, he eventually put a bullet in his head, so he didn't take care of himself enough. Now, as I often say, your trading will spill over into your life, and your life affects your trading. And you can end up in a negative feedback loop. So you've got to be very cognizant when you're thinking about taking a trade and make sure there's no extraneous influences that are influencing your trade. Now, in Reminiscence, he talks about Turkey. Turkey was a trader in the office, and they called him Turkey because he looked like a turkey. His name was Partridge, but he actually looked like a turkey. And he was always quick to say, well, we're in a bull market, or we're in a bear market. So if somebody would bring him a tip or something, he would say, well, we are in a bull market. And anyway, he says, well, you know that this is a bull market. He really meant to tell them that the big money was not in the individual fluctuations, but in the main movements. That is, not reading the tape, but sizing up the entire market and its trend. And right here, let me say one thing. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It was never the thinking that made the big money for me. It was always the sitting. Got that? My sitting tight. It's no trick at all to be right on the market. Men who could both be right and sit tight are uncommon. Now, the thing about my methodology, trend following with a swing to intermediate term time frame, is you're going to be wrong quite a bit. You're going to spend a lot of time less wealthy, but occasionally you catch a big outlier, and that just serves as a reminder where the real money is. Now, it started as a swing trade, and we stayed with this for a long, long time, and we were eventually stopped out, but we made some tremendous gains along the way. Now, I took a few more shares in this particular account. I have a smaller account where I did take the same exact amount that I would normally would for the trading service model. And I think it was about $17,000 or $18,000 there based on a 100K account. So roughly a 20% move in your entire account on one stock. And these are the type of moves that we live for. They don't come along every day, unfortunately, but they do come along just enough to make it all worthwhile. So these big trades serve as a constant reminder of why we are doing this, as opposed to trying to scalp all day and make 100 trades or be like the rat going for the cocaine. And believe me, I'm guilty of a little bit too much trading quite often. Well, we're just scratching the surface when it comes to Livermore, and I have quite more to discuss. And I also want to integrate a lot of the lessons that I've learned and bring in some psychology and maybe even some neurology to it. So stay tuned for more on that. If you need to reach me, again, davelandry.com/contact. If you want the slides from this presentation and all the other presentations combined, davelandry.com/StockCharts. I'll also give you all 3 of my books in PDF format and limited access to the members area. If you would like to attend my weekly webinars, go to davelandry.com/webinar. You can reach me again on Twitter at tfollowingmoron. I want to thank everybody for watching, and may the trend be with you.